watching Property TV.
Hello and welcome to Property Summits, the only show you need to put you firmly in the know when it comes to the latest developments in the property world. From 6 of the most experienced people in the business. Well, first off, best-selling author and serial entrepreneur Paul Mahoney, founder of Nova Financial Group, providing property investment advice with a particular focus on the buy-to-let sector. And joining me is Nicholas Warwick, an investor and developer who makes the most of his expertise in his role as CEO of the world's largest international property forum. We also have John Howard, someone who knows a thing or two about property, having bought and sold a staggering 3,500 houses, apartments and developments in his career. Tony Gimple is here too, the man in the know when it comes to tax, accountancy, finance or succession planning. Also joining me is Richard Bush, founder of the crowdfunding platform Crowdlords, which provides more people with the opportunity to invest in property. And last but not least is our newest member of the Property Summits team, Ranjan Bhattacharya, a man who's been investing and developing property for 30 years and uses that experience as the country's leading educator of property entrepreneurs. Well, lovely to see you all, gentlemen.
Thank you.
Hello again.
So one thing we know for sure is that inflation is on the up. Paul, what is that going to mean for property developers, good or bad?
Well, property developers versus property investors, I think it means two different things for them. I think for the common man, inflation is a bad thing. Costs of living going up when a lot of people are already struggling, that's not a positive thing for your average person.
And we're all feeling it, aren't we?
All feeling the extra costs, especially with fuel prices have significantly risen and most people use fuel. But for property investors, for someone like myself who's got millions of pounds worth of debt, it's not necessarily a bad thing. Property prices are generally rising in high inflationary markets, and that's evident at the moment. Property prices are rising much higher than they have for quite some time, in line with inflation, or somewhat in line with inflation. And if you think about it, if we've got 10% inflation per annum and you've got £1 million debt, well, at the end of that year, you've got 100 grand less debt in real terms.
Yeah.
So that's not necessarily a bad thing for people who have, appreciating assets and debt attached to those assets.
So that makes sense. So it actually weighing it all up, but it'd be good news if you're an investor. What about if you were thinking of getting into the business and developing an old building like this, for example?
Well, yeah, I suppose one of the downsides, if you're looking at developing, is the increase in build costs, because inflation being a basket of goods, and I think that's why inflation is so hard to quantify, is because regardless of who says what inflation is, it's all about what basket of goods you use. And if you're a developer, your basket of goods is probably very different to, the person who works at Tesco's down the road. Their basket of goods is very different to you. So yeah, for a developer, obviously costs of developing, the building costs have gone up substantially, which makes developing more difficult, makes making profit more difficult. And I've already seen some developers trying to pass those costs on, increasing the property prices due to, halfway through developments, for example, due to the increase in building costs.
Can you do that? Surely if you've written a deal, your deal's your deal, isn't it?
Well, no. So if you've already exchanged on a purchase, then of course you can't. Yeah. They can't increase the prices on you. But if they've sold half the development,
right,
there's nothing stopping them increasing the prices on the balance.
Yeah.
And I have seen some developers doing that over the past couple of months. You can only do that to a certain extent, though, because you're competing with the market, and if you've got a development around the corner that was completed 6 months ago, great. If the prices there are increasing, then you can increase your properties in line with that. But if they're not necessarily, then you can't really. So, there are challenges as well.
There is a time issue, though, for developers, and you'll know this, John, is that when the cost of materials or cost of people go up during the development, your lending is already fixed. So the lender would have said to you, okay, I'll lend you 70% of the value. And they judge the value on the valuation that was done at the beginning. So they'll have a ceiling on how much they'll lend you. but your costs have gone up and suddenly you've run out of money. And so you need to borrow money from somewhere else to fill that gap. And that's a real issue because, many people won't lend that extra money that you need to finish the development.
Yeah, I think what's happened certainly last year and so to an extent this year so far is that any increases in build costs have been masked by the fact that the property prices have gone up. The question I have for you, Paul, really is, do you think that property prices will go up with inflation?
Well, if you look at the past 12 months where inflation has started to rise, they have.
Yep.
You could argue they have.
They have.
Whether the two are aligned and that's why property prices are going up, who knows? But property price growth has been higher than inflation over the past 12 months.
Yep.
Whether that continues in the same direction or not is a difficult thing to predict, I think, because there is, of course, at some level an affordability issue as well.
Supply and demand.
By the way, the topic, we're talking about inflation, and we've got to look at what inflation actually is. And headline inflation is far short of real inflation. And Paul, you rightly mentioned the basket of goods, but what a lot of people don't know is that a loaf of bread, a loaf of bread today has a few less slices, but the loaf of bread is counted. And they've done subtle things, like they swapped out brown bread for white bread, which is cheaper. So what hasn't stayed the same is the basket of goods that they use to measure inflation over time. That has changed and it's actually a lot higher.
And that's the retail price index, which has about 300 items in it. Sometimes they take things out and they replace them with other things. Mm-hmm. But I mean, unless you're buying televisions every week, which have come down substantially. I think my first television I bought for my own house was probably more 40 odd years ago than it is now. But if you take those things...
And it was black and white as well.
And it was black and white. Very funny. Very funny.
It was deeper than it was wide.
I think Tony's it was very deep. Tony's, I think, was black and white probably. But so, they've replaced those certain items in order to manipulate the situation. I agree with you entirely. And the real level of inflation probably is double what they quote.
When's that going to hit home, though? I think that's the question that no one really knows. When's that effect going to kick in where people do realise that?
Third quarter.
Do you mean as consumers or as
general consumers? I think, because like Ranjan mentioned, there's interesting news in the press about chocolate bars getting smaller and all this stuff where they are.
That's probably good. That's probably good for the economy. Good for the society.
It's good for my kids,
Yeah, good for society.
But it's that kind of glossing over of the truth, really.
One of the points that Paul mentioned, which is absolutely spot on, is the effect of inflation on people that have a lot of debt. So that's great for the long term, but in the short term, it's very important to look at servicing and also cash flow. To have a strategy to increase your cash flow, because it's one thing to moan about costs and energy prices, which is not much you can do about. So the other way of doing that in the short term, so the inflationary effect of debt is great in the long term, but you've got to survive the short term to make it to the long term, and that's about making some cash flow in the short term.
And what's interesting is the market seems to be going with I call it over-regulation almost of the property market. It's pushing people more into rented, but then rents are increasing as well. So are we just exacerbating the problem of homelessness and people actually getting on the ladder from a purchasing perspective and even potentially a rental perspective in a few years' time? Where are we heading in 5 years' time, 10 years' time?
Well, nobody in this country has to be homeless unless made intentionally homeless by themselves. So they will find a home for them. So hopefully that will remain the case. I'm sure it will. I just think with this inflation, for me, it's a very unusual situation to have such high inflation and the economy doing well, but us worrying about interest rates going up and all the rest of it at the same time. It's a very unusual mix. And I think if everyone's being really honest, I don't think we'll know the full effects until the third or fourth quarter of the year, potentially.
We can only talk about what we think might happen,
Absolutely,
I suppose.
yeah.
And I suppose, from the way I look at it is, I have assets that are appreciating in value, which is great. If everyone's saying they've increased by double digits over the past year, which is fantastic.
Which I'm sure they have.
That is of far more benefit to me than an extra 50 quid per petrol tank. that I'm having to pay now. Now, I can understand that that's very difficult for a lot of people, and I'm not saying that it's not, but I suppose from the perspective of a property investor who has worked hard in the past to build a portfolio, it's actually not a bad thing at this point in time.
No, in the point of your career, at this stage of your career, I'm sure it's not. The problem, I think, is going to be the lack of confidence in the market. And once there's a lack of confidence in a property market, and you know, Richard, you and Tony and Ranjan, we are old enough to have seen this on many occasions, 2 or 3 occasions at least. What can happen? And once it starts to slide, it can really slide. It's whether inflation stops it sliding, in my view, and we can only normally learn about from the past, what's happened in the past. But this is quite a unique situation, Ranjan, isn't it?
But you're saying something which is actually alludes to the opportunity for property investors, because that sentiment is pretty much the homeowner.
Yeah,
the homeowner, the largest decision in their life is what property, what home to buy. But when and I think you mentioned in a previous episode how counter-cyclic it is. When people stop buying, they start renting. So this is the time for savvy property investors to get clued up and to invest in assets that produce an income, surplus to the cost of carrying them. That allows you to outpace the issues, short-term effects of inflation.
And it's the safest type of investment, obviously.
And we've all done them. When anyone talks about how they've made money in a recession, that's ultimately what they've done.
You talk about the savvy investor. Do you have to be the brave investor as well, though? If it's something, you know, you've got lots of experience and you're brave and you know that you'll ride the storm, but if you haven't got that experience, have you got to be brave?
Bravery just comes from educating yourself and having the knowledge. That gives you the confidence to take the steps, because no one's going to jump off a cliff, you know, unless they know they're going to survive or what's underneath. It's about knowing that you're not jumping off the cliff because you've educated yourself as to what that step
And that's all about de-risking. I mean, I talk a lot about, you know, de-risking deals before you buy them. So, you know, check out what's it going to cost to do. What's your return going to be? What can you rent it for? They sound simple things, but I can tell you the amount of people that don't check anything and just blindly, you know, sign on the dotted line.
Well, I think there are 2 key points there. One is, find your buyer before you even start in the first place. Because if you know where the property is going to be sold or rented to, you've got a degree of certainty, and obviously your due deal on them. And secondly, and we've all seen this, you know, in the trade press and generally, it's stop doing it by accident and have the right team with the right experience around you, who aren't going to sell you something just because they can, who aren't going to suck you into a training course just because they can.
No.
It's about you finding them, them finding you, and if they're not doing it for the right reasons or they cannot make a go of it, say no. No, I'm not going to take your money, because never in a million years are you going to be able to make this work for you as an individual.
You are watching Property TV. You are watching Property TV.
I think it's also important to keep in mind what's causing inflation at the moment. You know, if we go back to 2008, 2009, it was caused by an overheating market. The economy was absolutely booming, and therefore inflation went up. The economy is not absolutely booming at the moment. It's caused by a shortage. We've got a shortage of pretty much everything and major logistical problems due to COVID. So the reason for inflation at the moment is very, very different for the reasons in the past. So it'd be interesting to see how that plays out.
Well, the government is saying that it's short term. They're banging on about short term. But I spoke to a government minister a few weeks ago who said to me privately that they
not private anymore, John.
Well, it is private, because I'm not going to say who it is. I'm not going to say who they are. So it is private. But their view was they couldn't put interest rates up to more than 2% this year, and that would not be enough to control the inflation, because it's a worldwide problem. And that is a major problem for any government.
But keeping in mind, if we are actually talking about inflation being caused by shortages that are short to medium term, let's say, and those shortages will end at some point in the future when things get back to normal, do we need interest rates to rise for inflation to come down? Potentially not. And with the government, you know, and their main policy being, a little bit, you know, little increments. But if one of the main policies of government being increasing home ownership, increasing rates decreases home ownership. So it conflicts
It's a
with one
balance
of their
though,
main
isn't it?
policies.
One of the things you mentioned, Paul, there is this unique circumstance. It's different from 2008, 2009. And what you're basically describing, no growth and inflation, is stagflation. Now, I mean, I was just in nappies at the time, but John, you might remember the last time this happened in the 70s, stagflation.
Thanks. I think Tony
I like
might
what
have
you
done
did
as well,
there,
and
Jan.
Richard. But
I like
why
what you did
bully
there.
me? There's Richard and Tony here as well.
But we haven't experienced that set of circumstances for a long, long time, and it's not great for people without assets.
No, I agree.
Supported by debt. If you have assets, income-producing assets supported by debt, that is a ticket to ride through a period of stagflation, which for everyone else is not great.
It is, Ranjan, but the difficulty is it's hard to encourage people to get on the property ladder when there's so much uncertainty and worry. Because the average, I hate to use this average person, there's nobody average in this country, everyone's individual. But it causes anxiety and worry. And if they're husband and wife or partners, life partners, I believe is the term people use these days. One of them is more ballsy than the other one. The one who's cautious has got a very good argument at the moment to say, look, we don't want to do anything quite yet. We just want to wait, and that's the problem, because it's a snowball effect.
Market sentiment, yeah.
Market sentiment. Thank you.
I know that with sorry, Tony.
So I was going to say, people do have selective short-term memories. Turn the clock back. And I don't think any of us were alive during this period, but you had Spanish flu, which was the COVID of its day, followed by a war.
Followed by the Roaring '20s.
Followed by the Roaring '20s, which was probably fun.
Yep.
And then, when we had the oil crisis, and then when we left the ERM,
With the Depression.
you've got wherever we are now, history has already been with
I agree.
Western economies.
So are we going to have the Roaring '20s take two?
Yeah, exactly. I mean, we're all being quite
Paul
negative
seems
today,
quite
aren't we?
excited
100 years later.
Yeah, Paul, you go down very well, I have to say.
Catchphrase, don't we?
We're all being quite doom and gloom on this particular topic, but I think
But it's a
the
serious
economy
topic,
is
Nicholas.
it is a serious topic. It's
topic.
important to drill down to what's
Yeah.
important. But Tony's intimated there that we are potentially coming into a really good period as well. And as Paul said, maybe it's a little blip in inflation because of the issues with materials and Brexit and wars and microeconomic factors.
I read an
rather than
article the other
macroeconomic
day
factors.
that might worry some of us. And the article basically said that after a spate of inflation comes recession.
Well, yes, but that's because
As it did in the 20s, 30s.
that's because counteractions against a booming economy causes an inflation. Significantly high interest rates to bring down inflation causes a recession.
We're not
like
there.
it did in 08, 09. We're not there at the moment. So
Well, we weren't there in 0809. I mean,
we were there. We weren't there in 07. We were there in 08, 09.
Interest rates have never been as, even if they go up more this year, it's peanuts compared to, Tony, I don't want to bang on about it. You, me and Richard, and Ranjan to a point, but only till he's younger than us.
Can you
But
start with
how
Ranjan
much
next
was
time?
your interest on your first house purchase? What was the interest you were paying on a house?
On my first house, interest was probably 3 or 4%, and
And then it went up to what?
15, 16%.
15%.
That was the early 90s.
So what you're saying is
That was when we
property
came out of the
still
ERM.
works at 15%.
Well, what I'm saying
Bill
is,
done.
the
Let's finish the
average.
show.
What I'm saying is the average interest rate for people owning their own home, buying their own home through a building society, until the last 15 years was about 10, 11% a year.
So why is everyone so worried about rates rising 2%?
No, hang on. Rates have only risen. The rates have risen recently, but they're still just back up to
Tiny,
what they were
tiny
pre-COVID.
amounts, fractions of
No,
amount
it's the
what
same
they
as what they were pre-COVID.
Yeah, so
They've just reduced.
it's fractions. So people used to spend a lot more money on a mortgage compared to living, and that's what potentially we could get back to with the cost of everything increasing. They've got less money to go out for dinner, less money to buy coffees, less money to go on holiday, and that's the problem.
But they've also saved up a ton of money from being in COVID for 2 years, not going on holidays.
Very few people ever save money these days. It used
Well,
to
they
happen
have
years
done,
ago.
John.
But
In the last 2 years,
well, maybe some
they haven't been able to spend it.
Maybe some have. Maybe some have. Maybe some have.
Look where we started the day off. A new paradigm. Just about everybody you talk to or talk with about the environment, about inflation, about the very recent past, have suddenly focused on really what's important to them, which is, being close to home, not over leveraging. And it won't be, every generation or so, there is this major change in outlook. And I think that's what we're going through at the moment.
Tony, I think you're being a bit naive with respect. I think that's, there's always that sentiment, but whether people behave in that way or not, I don't think. History tells us that that's not how.
They have short-term memory, so I think
short-term,
they do think
It's
like
how
that,
we'd
but
like
then
to
they
be seen,
lose that
to be
vision
behaving,
quite
but it's
quickly.
not how we behave as a society.
Because they have to put themselves first in order to put food on the table and the roof over their heads.
We're selfish beings.
Yeah, absolutely. It's just part of being a naked ape and another part of nature. You can't help it. It's what we do, as a species. The fact that we've got opposable thumbs, big brains, and the ability to look up and say, "How the hell did I get here?" And the rest.
I've never felt like a naked ape in the field looking up at the sky, Tony. I don't know
what that
about
has
you.
to do with inflation, Tony, but
No.
Let's get back to the point.
Listen, I think history does repeat itself, and there's two groups of people here really. There's the sort of general public that looks at property for their own home, and then there's the property investor.
I agree.
And if we look at the property investor, the key issues right now, I believe, are first of all making sure that you have a reasonable cash buffer. You'll need more cash reserves than before. But at the end of the day, if you can secure debt and fix the cost of that borrowing for a reasonable length of time, and in the knowledge that the cash flow, the monthly cash flow that you're going to make on that property is a certain amount, is going to stay stable over 4 or 5 years, and you fix your debt for 4 or 5 years, there's enough time to ride through this stage of the cycle.
Yes.
And from history, if you follow that strategy, you'll always come out the other end.
Also keeping in mind that anybody who has remortgaged in the past 5 years has been stress tested at a bench rate of 5.5%.
Yes.
So even if they're borrowing at 2 or 3% at the moment, there is a 2.5% buffer there for rates to rise, and they can still afford that and more than break even. Otherwise, the bank wouldn't lend them the money.
and don't panic, and don't worry.
Absolutely.
And inflation has had an effect. It depends on markets, but during COVID, residential rents went down a little bit. Of course, there was occupancy issues in some areas, but they've bounced back and they're pushing ahead now. We are implementing our Section 13, the notices for annual rent reviews now, and they're being accepted. People aren't moving out, so rents are going up. So what inflation will do is mean that your debt will be frozen if you've got a fixed rate, but your rent should increase in time as well because of the inflationary effect.
Good point.
And
Perhaps it's more immediate for developers than it is for property investors.
Yeah, they're selfish, this lot, aren't they? I mean, what about poor old developers? I mean, Nicholas, me, Ranjan to a point,
Well, I think there's a key difference, and it's in language. Yeah? Pretty much all of us here are running professional property businesses.
Yes, that's true, Tony.
Yes.
Yeah, and whether that's as landlords, whether that's as developers, but this word, property investors, keeps creeping in. Yeah? So if you're going to do it, developer, landlord, whatever,
Be professional.
do it the best possible you can, highest standard. Talk to the people who do it for a living as businesses.
I agree, and I think you just need to be more cautious than you have been, because we don't quite know where. And look at us all here today. We've all got slightly different opinions. We're all saying be cautious, though, aren't we? That's the one thing that comes out of this, I think, is that we're all saying be cautious. Yes, inflation's going to have an effect. It might be good for Paul. He's smiling about it. For others, it may not be so good.
Well, there you go. That's a good point to stop. So caution, make sure you're not caught out. Thank you ever so much, gentlemen. Until next time, bye-bye.